For more on finance, I'm joined in Sydney by Tony Boyadjian, Senior Vice President of Foreign Exchange at Compass Global Markets. A very good morning to you, Tony.
Good morning, Dale.
So we've obviously seen Hurricane Harvey and Irma. They've caused widespread damage in the US. What's the likely economic impact for that country?
Yeah, it's been unprecedented damage there, widespread in Texas, Louisiana and Florida, Dell, and the massive cost estimated now is around $290 billion, or 1.5% of US GDP, and it looks like it's going to further shrink the US balance sheet going forward. We've seen US President Donald Trump come to an agreement configured by the Democrats to raise some funds for those stricken by the hurricanes. It's made the congressional Republicans unhappy with the deal that he's done. So it continues to limit the upside on the US dollar because they've got low inflation there at the moment in the US. The Federal Reserve doesn't want to raise interest rates again this year. In fact, there's only a 30% chance that they will do so again this year. And that's keeping the US dollar on the back foot. And meanwhile, we've seen safe haven status of other currencies like the Swiss franc, the euro, the Japanese yen, all countries with very strong current account surpluses do well in times of uncertainty, especially with the geopolitical risk in the Korean Peninsula as well.
Yeah, it certainly is going to have a knock-on effect for the US economy, as you explained. And you mentioned inflation. I want to talk about Chinese inflation data because that's obviously come out. What does this mean? What does it mean, I guess, for the Australian economy?
Yeah, the Chinese inflation number we just saw recently, Dell, was much stronger than expected. In August, the CPI rose from 1.4% to 1.8% on an annualised basis. The Chinese economy is in good shape, Dell. It looks like that economy continues to grow just shy of 7% per annum, and that bodes well for Australia because their manufacturing sector is strong. There's going to be demand for Australian products in our resources in particular. This time last year, the price of iron ore was 58 US dollars a tonne. Today it's 74 US dollars a tonne. Every $1 rise in the price of iron ore generates an extra $250 million revenue for the Australian government. So the Australian terms of trade have really improved, and that's helped the Australian dollar move higher. This time last year, the Aussie dollar was trading at 76 cents. We're above 80 cents today, and it's those terms of trade which is helping the currency keep its head above water. So we're forecasting the Australian dollar to remain sideline between 78 and 82 US cents for the time being, where we're not as optimistic on the top side as others are, Dell, because there are still some concerns. We have a low wage, high debt story which continues to play out for the Reserve Bank, and they've been sidelined on interest rates for perhaps the next 6 months now.
But Tony, talking about the Australian dollar, of course, one of the things that has helped our exporters has been the Reserve Bank policy to try and keep that Australian dollar low. Given what you've just said about China doing quite well and, of course, the US economic policy, perhaps the Fed not moving those rates, could you see the Australian dollar continue to rise, perhaps even above that 82 US cent mark?
Oh, certainly. But for that to happen, Dell, commodity prices would need to continue to rise from where they are. We've heard Philip Lowe, the Reserve Bank governor, mentioned a few times about the concern of a higher Australian dollar. He's actually said that the preference is for a lower Australian dollar to maintain or enhance Australia's international competitiveness. If commodity prices could maintain their range, then sure, we could see the Australian dollar a lot higher. But given that the Reserve Bank remains sideline on interest rates, which are at record lows of 1.5%, given the high debt, low wage story in the market at the moment, they'll be reluctant to change interest rates. So their monetary policy is neutral, which means it'll be outside forces that determine the direction of the Australian dollar. China's helped the Australian dollar recover from 76 cents last year to 80 cents this year. We believe 82 cents will need to be looked at very carefully. If it breaks above 82 cents, then certainly it can climb higher. Otherwise, look for it to remain between 78 and 82 cents short term.
All right, Tony Boyadjian, great talking to you. Thank you.
Pleasure. Thanks, Del.